It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another episode of the Real Estate Breakfast as we cover your property news. Yes, we do that 7 days a week, as heard on iHeartRadio, also Spotify, Apple Podcasts and Amazon. Woohoo! We have got to the end of the working week. Well, almost. Brand new Friday, July the 26th today. And we're going to be having a look at the cost of living crisis that is affecting not only tenants, but also landlords. Now, if you are a landlord, have you noticed the increased costs around maintaining rental properties? Well, the latest Domain rent report shows that record high rents in capital cities, for example, $650 per week for houses and $630 for units, is up 11.1% and 8.6% respectively. And also that landlords are facing negative returns due to the higher costs. Rental yields have declined in Sydney and Brisbane, but risen in Melbourne. And the Property Investment Professionals of Australia highlights high interest rates as a major factor in the supply-demand imbalance. And don't we know that we certainly have that at the moment? So let's catch up with a landlord of properties, Jeremy Britton, a Queensland investor this morning. And good morning to you, Jeremy. Welcome to the Real Estate Breakfast. You have been a landlord, I think, for around 20 years. Now, this cost factor of maintenance for rental properties, it has risen over the last few years. So perhaps break that down for our listeners this morning in terms of what landlords are now facing.
Thanks, Craig. Thanks for having me on. Significant cost price increases that we've had, particularly since 2020 with the pandemic, and prices of timber and prices of steel and things like that have increased dramatically. And those things have sort of cascaded right throughout. So we got a quote to do some renovations just before the pandemic. It was $60,000. But then when it came time to actually get the material and start the renovation, the price had increased to over $100,000. The costs have increased for everyone. So the tradies have put their prices up. My accountant has put his prices up 20% over what they were last year. We're running a business. At the end of the day, being a landlord is a business. We're not selling donuts. We're providing a roof over your head. And if the price of all of our material services have gone up, then we just have to put the rent up. But we just have to do it. It's the cost of doing business.
Gee, it sounds like you might have to get a new accountant 20% up, hey?
Well, he hadn't put the prices up for about 5 or 6 years, and then finally he reluctantly put them up.
Right.
So, and the same thing with our rent. Like, we hadn't put up the rent since, I think, 2018, 2019. And, of course, when the pandemic outbreak happened and our tenants were working in hospitality, they couldn't work. We didn't take any rent from them for 3 or 4 months until the incentives and things kicked in from the government. So it was a loss there. And meanwhile, as I say, the prices of things have kept going up and up and up. And as any business, the last thing you want to do is upset your customers. So you hold off for as long as you can. But sooner or later, you just go, hey, I'm losing too much money. I need to put my prices up whether I want to or not.
Now, Jeremy, there will be tenants, of course, who will say that rents are rising. Why should we feel sympathy for landlords who say that they are struggling as well? What do you say to that?
Probably don't feel sympathy, but just feel empathy. When you go and buy your food, like the prices of food have gone up by 20 or 30%, sometimes 50%, depending on where you're shopping. And you don't get cranky at the person who's actually operating the checkout because it's factors beyond their control. And as a landlord, yes, I have put the rent up on the property probably by about 20% in the last 3 years. But again, there was 4 or 5 years before that where we didn't put the price up at all. And our costs have increased significantly. I mean, the interesting thing is, and I had this when I was a renter, I didn't understand, if the interest rate goes from 5.5%, to 6%, you go, oh, that's not much of a rise, but it's actually more than a 10% rise in the cost for the landlord. And when the tradies put their prices up and the cost of materials and the cost of transport goes up, it goes up for everybody.
And Domain, now they reported that when you compare the average rate for an investor loan to the gross rental yields, many will find their costs are still exceeding their income. Now, it sounds like that's applicable to you in terms of what you are experiencing. So can you break that down for us this morning?
Yeah. So you might be paying 6% interest on the mortgage, but then you've got your on costs. Obviously, you've got your insurances and you've got council rates and you've got other things in there, repairs and maintenance. And the rental income might be coming in at sort of, 4%, 4.5%. And you go, I'm losing money every single year. Fortunately, you can offset that against tax, but still, you've got to lose the money before you can actually claim that back. So the only thing, the advantage for the landlord is the property price will generally increase over time. So it's sort of losing money hand over fist every year for the hope of a gain 5 years down the track.
And let's have a look at some of these rental yields. If we go to Sydney, the gross rental yields, they have declined by 0.8% year on year to 3.04%. In Brisbane, they are down 6.3% to 3.95%, but in Melbourne, they are up 9.7% to 3.65%. So, the pressure of holding and maintaining the debt, that in itself can be a very tricky thing to navigate. There are going to be a few balls in the air across an entire portfolio. And let me ask you this, Jeremy, is there a magic number of properties that make it easier if you spread the debt across a entire portfolio?
I think the first property is always the hardest. When you're saving up to buy your first property, you're still paying rent, and it takes a long time to get a deposit. But once you've got that property, then you can leverage the equity in that property, get your second property, and spread the debt over that and make it more tax effective, because of course your own home is not tax deductible, but your investment property is. So once you've got the second property, then you can more easily get the third and the fourth and the fifth and the sixth and so on.
All right, then, we are talking with Jeremy. He is in Queensland. He is a property investor, a landlord. We will talk more about the investor property market next.
We help to break down real estate every day to help you better understand the Australian property market.
And right now it is time for another 30-second property tip. We are going to the Gold Coast and to Joe this morning. How are you doing, Joe? What have you got for us this morning?
Look, Craig, do you know what? We find a lot of people are starting their property journey, and when they start looking, they may not expect to find something that they love straight away. So that really means they don't have pre-approval and they feel like they're not in a position to start putting offers on. One thing that we do know is that should not be a barrier. A good agent will have great contacts, and they'll either be with major lenders or really, really good mortgage brokers. We personally have great relationships with both. So really getting to talk to your real estate agent and where you're at with your finance journey and your property journey is really important.
You can join the conversation every week on the Real Estate Podcast.
And it is a Real Estate Friday. We are talking properties and the amount of costs that have carried forward over to landlords across Australia. And Jeremy is with us. He is an investor. You were talking about just before the break about having to increase some of your rentals. How often are you having to increase the rent on some of your properties at the moment?
Well, it's been the first increase we've done this year for about 3 years. And, if you get a good tenant in, you want to look after them. So it's usually, a 2 year or 3 year thing where you reassess. But again, sometimes you have to look at the cost of insurance. Anyone who's insuring a car or a boat or whatever will know that the insurance has gone up by more than 10%. I've got a friend who owns properties in the US, and his insurance bill has gone up by literally over 500%. Because of where his properties are, they're more inclined to be floods and hurricanes and things like that. So he's just choosing not to insure now, because when your costs gone from $20,000 to over $100,000 for insurance, he's just going, no, I'm not doing it. Whereas most of the other ones, it's usually a 5 or 10% increase every year, but often we'll hold off for a few years in a row because you want to protect a good tenant and keep them.
Just in terms of the insurance, because you're in Brisbane there, I guess when you first started out buying properties, there's things now that you will look at in terms of an investment that when you first started may not have been top of mind. And, the floods, obviously, that's a really big issue.
Yeah. I mean, there was the famous 1974 flood in Brisbane, and they said that was a once in every 100-year event. And then we had another flood in 2011, and then we had another flood 2 years ago. And you go, hang on a second. Maybe there is such a thing as climate change, but there's a lot of people who are actually jacking up their Queenslanders on stilts now and building in underneath. And there's some places who just simply cannot get insurance anymore. There's some suburbs where, insurance companies just will not cover them anymore.
Yes, and we've been in this 15-year plus cycle of low mortgage rates. I was reading a report the other day out of the US where they're predicting that the low rates that we've had over the last 15 years are unlikely to ever return back to the lows in our lifetime. What do you think about that from an investment point of view, if that was true for Australia?
I think like when my folks bought their first house was, back in the late 80s, and interest rates back then like were 12, 13, 14, 15, 18%. And the Reserve Bank had to put up the interest rates by a fair bit to slow down the economy. My folks borrowed like $60,000 to buy their first house. So you had to put up the interest rate a lot in order to get the payments to go up in order to stop people from buying property and slow the economy down. But now when you're looking at properties that are costing 10 times that, you only have to put up the interest rate by 0.25% to have the same impact that putting up the interest rates by 2 or 3% did, back 30, 40 years ago. I think, moving the interest rates from 5.5 to 5.75 to 6% to 6.5, that's going to crush the economy just as much as having the interest rates of 12 and 13% did back in the day. And of course, going forward, the house prices will increase. There'll be just little tiny adjustments that they have to make, 0.25% here. And it doesn't sound like much, but 0.25% on $1 million mortgage is a lot.
For sure. And in terms of other investors that deciding to sell off maybe part of their portfolio, do you know people that have sort of just hit that wall where they go, no, can't go any further, I've got to liquidate?
Yeah, I do. I mean, I've got a friend of mine who went nuts during the property market boom and leveraged against the other, and he ended up with more than 20 properties. A lot of them were in sort of outback towns, smaller prices, which have obviously been feeling the pinch a lot more than the CBDs. So he's having to let some go, and other people are feeling the pinch. I think the report said the other day there's over a million Australian households who are in mortgage stress. So they may be late on one payment. They may have skipped one payment because of the cost of the mortgages have gone up, and they're having to reevaluate. Do we sell, or do we actually cut back our lifestyle? Do we sell the extra car so we can actually pay the mortgage for this month? People out there are feeling the stress. Yeah, absolutely.
All right then, well look, great to chat with you this morning and get the landlord's perspective there in Queensland, in Brisbane, and thanks for coming on to the Real Estate Breakfast this morning, Jeremy. Enjoy your Friday, enjoy the weekend coming up.
Thanks, Craig.
Every morning from 6 a.m. across Australia, we deliver you the latest property news, commentary and predictions from Perth to Cairns and from Melbourne to Brisbane, 7 days a week, only on the Real Estate Podcast.
It's important to note that on-site managers are real estate agents, so the first thing that you need to do is to complete your license training and get accredited so that you have a real estate license. There's a couple of different levels of real estate license. In Queensland, the first level is called a resident letting agent, so an RLA, resident letting agent.
Do you have many real estate agents themselves deciding to get into your industry?
Yes, sometimes, and often will swap around with buildings. So they'll buy the management rights to a building. It may be an underperforming building, and it'll be that they buy that at a good price, and then they can build that building up, grow the letting pool, increase their revenue streams, and then in turn that increases what's called the multiplier, and then they can sell that building at a profit.
We connect you to the best real estate information across Australia. The Real Estate Podcast.